Good afternoon, everybody. Sorry, we are 10 minutes late here. We had some technical issues. I don't know if anybody see the northeast, but like most of it's been wiped out from wind, so we're lucky that we have power. Anyways, sorry about that. So super excited to have you guys on the call today. We are at episode week 5 with Taking Territory. Here's the deal with week 5. So the last couple of weeks have been really focused on the platform, which you guys have seen, and hopefully you enjoyed your bonus calls that you were listening to, along with deep diving into the platform from a business standpoint, looking at it. What I want to take us through today, which I need you guys to hang with me for a little bit, is the platform of financials. And here's the interesting thing about financials. I want to talk about from a mindset, and then we're going to dive into actual financials as well too. Again, you're going to hear me communicate with you guys at a level of how to run a business and how to operate. So metrics and signals and things that I look for in organizations, not just in real estate, but in all the companies that I own. What are the metrics around this? How do you surround yourself with money? What is money? And these type of things. So we're going to take a deep dive into building the platform of what it looks like financially to be in the particular here of what it's really about. So let's first start a little bit and talk about. First of all, money is not a dirty word, right? I think we all get caught up in thinking that we're afraid to talk about money. It'd be like this. If you loved pizza and you're walking down the street and you're like, hey, have you had any good pizza, Lisa? Yeah, I love pizza. I love cheese on it. I love pepperoni on it. People talk about pizza freely, but if you love money, and it's okay to love money, right? It's okay. Money, first of all, I think it's not okay not to want a lot of money so that you can help out as many people as you can. And we'll talk about that after. But this is something that we've got to get our head around, that it's not afraid to talk about this at the dinner table. Like, people don't talk about money. It's like, well, why not? All of it is, by the way, is a piece of paper or a decimal place in a bank. You have to understand, money elicits feelings. And the thing is when we're after a certain dollar number, what we're really after is a feeling that we think we're going to get when we hit a certain financial goal. And so when you say, hey, I'm going to make $500,000 or $100,000 or $1 million. By the way, how many people on this call, raise your hands right now, have literally made more money than they made 10 years ago? And how many people on this call, keep your hand up, right? How many people on this call 10 years ago, if you're making the amount of money you're making now, you would have been like ecstatic? Right? And so the interesting part is, as you grow, right, as your level of consciousness raises, you start to understand that money is only good for the good that money can do. And what it does is it elicits it gives you options to be able to do certain things. So I want us to get in the habit of, it's okay to talk about money. It's okay to talk about it with your friends, with your partners, with your kids, to make sure they're versed on these things, with your business partners, by the way, really closely. The reason why most of us don't want to talk about it is because we're embarrassed, or we don't know what we're talking about, meaning we don't have proper platform set up financially to be able to articulate exactly what it is, or we're just afraid to look at it. So don't be afraid to talk about money. It is not a dirty word. It is something that's a tool that's in your life. One of my affirmations that I say every morning, you guys might want to write this down, is money is a tool. It goes, actually, the way they all go is money is a reflection of the value I add to this world. Money is a tool that I use in my life. Money allows us to do really amazing things for other people, right? So there's a lot of these things that you can do these things. Hold on. Can you guys all hear me? I just saw somebody say that we don't have sound. I just want to make sure you guys can all hear me. And maybe it's just one person. So if somebody wants to just write in there, I'm assuming most of you guys can. All right, cool, perfect. Thanks, David. All right, so Tom, you might just want to look in there as well too, and maybe unmute yourself or whatever it is you need to do it. So when you think about money, think about that. It is not something to be afraid of. I want you to start the conversations, by the way, with your team members. And if you're an individual agent, as you build your team, I want to make sure that these conversations are continuing so they don't become the anomaly of not being able to communicate these things, because money drives a lot of things in this world, right? So let's just not be afraid mentally to have these conversations around it. And by the way, you can have money in sunsets. It's always like, right, people that don't have a lot of money, and I'm just categorizing a little bit, but like people that don't have a lot of money, they often say, like, well, I'd rather have a sunset. Well, who said that you can have a sunset and I can't because I have money, right? You don't have to choose between money and sunsets. You can have both of them. You can have a sunset and you can have money, and in fact, the more money you have, the more sunsets you're probably going to watch, and the better experience of the sunset you're going to have. The more money you have, you might be in a jet watching a sunset versus what it is. So those are the experiences that it can give to you. You just kind of hear this conversation around money sometimes like, oh, you work too hard to have this, or I wouldn't take that risk, or why do you want all this money anyways? Why do you want to do these things? Here's the interesting thing about money, though, is that the people who want to retire never can because they don't have the financial capacity to do that. And the people who can retire never do because they know that money is just a tool that they have in their life to produce a certain amount of good that they can give to the world. That's the difference. So understanding you can have sunsets in Italy, right? Adam, I like how you're thinking, buddy. You can have them anywhere you want. That's the beauty about money. Let's just understand that. Let's have this and promote this conversation amongst everybody so we understand what it can do and where you're at for different things. You can have both sunsets in there. Here's the trick part about all of this. I want you all to get obsessed about making others filthy rich. I mean obsessed about making others filthy rich. Think about it. Not only will you guys get where the angle goes is not only if they make you make them rich, then you become rich. We all get that part. We understand that. I want you to get selfish with wanting to make a lot of people a lot of money. Not only because you're going to get rich, but mostly because you're going to give somebody the opportunity to use that tool, that money, that currency that we have coming in there to get the feeling of why they joined your company in the first place. Let me paint you an example. You can make $100,000, and by the way, when you make $100,000 in your tax returns, and you're like, wow, there's not a feeling that you get all of a sudden when you have that. The feeling you get is when you go to you go to Walmart the day before Christmas and you start paying for people's groceries or toys, or you give money to somebody who really needed it, or you retire your mom, or you buy a house for your kid or something. That's the feeling that you get. So understand that money is a tool that allows you to get the feeling of why you're in this in the first place. Business is a conduit for our own personal growth. This is the growth that we can have, the maturity of understanding and the mechanics of why money is important and the options that it provides. If we don't fundamentally understand the emotional side of money, we allow money to run us. Here's the distinction that you have to understand with money. If you become wrapped up in the identity of money, you actually become it. So therefore, your life rides in the roller coasters of both money when you have it and the downside when you don't, and your identity is attached to it. Well, just like with thoughts, you have to separate. You have to become the witnesser of the thoughts themselves. You have to become the witnessing of the tool called money in your life. And once you really understand, visually have that conscious contact with the thoughts and understanding of what money really is, you see it as a tool. And that's what it becomes. Because I want you to mentally get here, because then once you're there, then you'll be able to start making different decisions versus understanding that money does not give you an identity. Money gives you tools to provide options to people for your life and for people around you. So I want you to, and you should write this everywhere around your office, in your little cubby, wherever it is, but you need to be obsessed with making others filthy rich. The more you can do this, the more you can practice this, the more you make it about other people, the more your life will be enriched from a way that you will understand. And I don't just mean that from like a spiritual way, your life's going to be enriched. I mean you're literally going to understand the feelings that you're looking for to net $1 million is going to come from another object. I really wish I could just give you guys all $1 million right now and understand that that's really not what you're after. You have to understand that. You are not after the money. You're after the feeling that doing something with the money is going to give you. Even if it's something that you buy, it's still, hey, I want to buy a house. It's the feeling of that. So money is the tool, the object of what that is in order to allow you to get the house, the giving, the car, the jet, whatever it is that you want to do or give with your money. Money is just the catalyst or the tool for that. We see money as the object or as the feeling, which the separation needs to occur. That money is just a tool to give you the feeling, the objects you can do. So I want to just break this down for you guys because it's really important. If there's anything I've learned about money over the course of my my time building organizations, it's that separation of it. When I first started, I became the identity of money. My life would go up and down with it. If I had money, I was ecstatic. If I didn't, it was freaking out, right? It's being able to handle the emotional side of money, which is why you see people who win the lottery, right? These are numbers that come, these aren't just made up, right? when people, I think it's like 75 or 85%, I don't know, somewhere in that range, of people who win the lottery within 7 years are in a worse off financial situation. Not the same, the worse off financial situation, because they become emotionally tied to it, and they spend all their money thinking that it's going to come forever, understanding that it's just a tool to have an aspect. By the way, if you ever win a lottery, the best thing to do is take the annuity payment, because then it forces you to gain the knowledge of earning your right to be where you want to be. We understand when we talk about building a business, it's going through the grind of 5 to 7 years to build something, all those hard challenges, the grit, the bootstrapping, putting your money back into an organization. You have to understand too, by the way, when you want to grow an organization, you have the option of two things. You can take profits or you can take growth. But you rarely can take both, not in the beginning. So when you're building an organization, if you're an individual agent and or you got a team and you're like, hey, I'm going to get to the next level, I'm going to double down on these things, and you got to invest in growth, understand you're taking away from profits for a period of time to recoup them later on. Now, the longer you prolong the growth phase, the larger the return is going to be. The longer the deferred gratification of that, the larger the return is going to be. The longer you can go without pulling money out of an organization for profits and keep it in there for growth, the larger and more exponential the return is going to be. Most of us just start taking it out after the first week. And then we wonder why organizations don't grow. Well, first of all, you have to understand when you take it out, you're taxed at 30 to 45%, right? Depending on where you're at. Your tax bracket. So just taking $100 out, you've given up 40% of it, versus putting it back in the growth. You're actually using the government as a partner in your life to grow. You guys get that correlation? Right? You're using the government. They're giving you 30 or 40% to grow because you take the expense by growth through there. And then when you decide at some point, when you hit that hockey stick curve, that growth trajectory of what you're doing, that's when profits way exceed your expenses, because you've dumped so much in the growth that it's impossible to catch up with the profit number now through growth. Not impossible, but it starts becoming a very large number. If you look at Gary Keller's life, that's what it is. For 7 years, he put millions of dollars every single year, back into Keller Williams, back into Keller Williams, back into Keller Williams, 7 years until they turned a profit. And then they went from $1 million to $800,000, $1 million loss, $800,000 loss, $600,000 loss, $400,000 loss, $500,000 loss, right? You get the whole point there. And then it was a $250,000 profit. And then it was $1 million profit. But then guess what happened? Then it was $8 million. And then it was 16. And then it was 29. You see that? That's like all of a sudden your expenses can't keep up with $29 million in profit. So I want you guys to feel that and understand the emotion behind what money is. Because the rest of what we're going to dive into this, if you don't understand that money is a tool in your life, personally and professionally, then you're not going to wrap your heads around the rest of this. So understand that building an organization, 95% of what you do is psychology, and it starts with the money aspect, right? You can be relentless, you can be grind, you can do all these things, but if you don't know how to manage money, or you allow money to manage you or own you, you are fucked, right? You are literally in a situation where you're going to be in a tough spot. And I've seen too many people go through that phase to not be able to bring that to you guys to understand that you've got to be obsessed with making people money. Most of us, by the way, are still thinking about us in terms of money, which is why we're not where we want to be. The minute we make about other people, it's going to do this. So here's something else I want to share from you guys. So Gary wrote this out for us. We're really what stops people from being a millionaire. And this, again, is a little bit about mindset, but I wanted to add a few things in there to really prime us for today. But I thought this is very fascinating, and hopefully you guys do as well too. This is something he wrote out. So this is Gary wrote this out. I just want to share it with you guys, and hopefully you don't share it with everybody else. I'm not even sure if I'm supposed to be sharing with you guys, but it's out here anyway, so you're going to see it. So what keeps people from being a millionaire? And the first step is they need to visit their capital. So what does that mean, right? It means is that they have to continually extract their capital. They don't feel that that the money inside of what they're doing is actually making enough money, so they feel they have to go visit. They have to take it out of the asset constantly from what it is. So again, remember I talked to you about the more you pull out for profits, the less you have for growth. Therefore, you're stifling your growth opportunity. It's the same thing of having to revisit your capital. Number two, is there a paper millionaire versus cash flow millionaire? One of the problems with today is Amazon went out there and decided to convince the Wall Street and convince the capital markets that you did not need to make money in order to be a billion-dollar company. So when Amazon set the bar for this. So there will be a book and a movie written on this at some point in our lifetime that we will see how Amazon literally is like somebody in the back end of it and said, somebody woke up and said, you know what, we actually can become a billion-dollar company, a multi-60, 80, $100 billion a year company without turning a profit. How do we do that? We just convince people of the value. This is going to be a movie at some point, right? We're going to see this happen. And ultimately, that's what Amazon did. So they went out there and they convinced people that they didn't need to turn a profit to be worth a tremendous amount of money. Now, Amazon's providing a tremendous amount of good, and now they're getting to a point where they're certain profitability. But I mean, for 10 years, come on, right? Now you're seeing all these companies doing it. You're seeing it with the companies inside of real estate. You know, even other organizations like Redfin, who goes out there and gets a $2 billion valuation, who's losing $30 million a year. Wouldn't it be awesome to go run a company losing $30 million but be worth $2 billion? They literally have trained the markets to be a paper millionaire or billionaire versus cash flow. By the way, the person you should always watch for investing money is Warren Buffett. You know what Warren Buffett buys? Companies that are cash flow producing. You know why he went into real estate? Because there's a tremendous amount of cash in real estate. You know why he went into insurance? Tremendous amount of cash in insurance. This is what the avenue that he went after to become a cash flow millionaire or a billionaire or a trillionaire, right? Whatever it is that you have your eyes set on, it's the cash flow that matters versus paper. Now, there's nothing wrong with created equity or created value of real estate or companies, but just understand you cannot live off being a paper millionaire unless you sell an asset. So the goal is to make sure that you are focused on cash flow to cover all of your debt, to cover the debt of an organization, and to invest back into growth. So think about the cash flow. The cool thing is we are in an organization and a vertical, i.e. real estate, that provides a tremendous amount of cash. And it's really, really awesome to be there. So the urge to be liquid, number 3. This is that you feel that the best way to increase your growth is to have cash on hand all the time. Well, cash on hand, outside of having 6 months reserves in an organization, really does not grow your base. It's not working for you. Go back to Robert Kiyosaki's 4 quadrants, right? You move from employee to, self-employed to business, and then to an investor. An investor is really where your money starts working for you. So just understand that. Now these really gets into some good ones. Number 4, debt. You have too much debt. Therefore, the only way you see yourself getting out of the debt is to sell the asset and pay off the debt. Therefore, subjecting yourself to taxes and different things. Happens also. We just get into too much debt from these things, so we have to sell assets. Number 5, the need or the urge to live high on the hog before their cash flow can support them. Pretty self-explanatory, right? You're just living beyond your means. So when I went and I talked earlier about, and hopefully I drive this point home, and you guys get pissed at me from driving home so much, is that literally when you're taking money out to buy personal things, that's profit. So even though you're not taking it as cash, you go you go on a $20,000 trip, or you go on you buy a car or a tractor, whatever it is that you buy, you're taking profits out of your business. Even though it's counted, that's still, you have to understand, that's still a profit, even though you can classify it as an expense on your business, because it's not pushing the organization forward. Does that make sense to you guys? So figure out how long you can defer that gratification for, or figure out how much it is that you want to pull out every single month, and then just know that that's where it's going to stay. And as you increase your income, put it back into growth. Number 6, don't see people as an investment asset. Probably my favorite one is that most of us when we think about people, we go, how much they're going to cost? Whereas I look at people and say, how big of an investment are they going to be in our organization? How large of an asset is this person going to be? Because you truly understand that people are your greatest asset, and they will be able to provide a return far greater than any other metric used out there. They will provide a far greater return than any other aspect in any part of your life. Understand that if it's the right one. A wrong one, they could be a disaster. If it's the right one, they will provide a tremendous amount of return on dollars, on return on assets, far beyond anything else that you could put into the stock market anywhere. So the other one is they don't have a written down wealth building plan they trust. So really they don't know how they got rich, or they made a certain amount of money and they don't know how to do it. They don't follow the model or the plan of how they get rich, or of how other wealthy people do it. I'm going to show you in a second how wealthy people do that. They spend more than they make, or they spend all that they make. Understand that. That's a lot of people. You know, most people spend more than they make because they increase their income, they increase their lifestyle. They have a bad month, they have to dip in the savings. They have 2 bad months in a row, now they're almost broke, right? This is what happens. This is why you have to control yourself to be able to say, you know what, I'm going to invest into growth instead of profits. And you keep it there, you don't have the money investing in the growth, it doesn't allow you to make those decisions right away anyways. And then the last one is, look, they don't study the money or the rules of investing. You know, I see people who study sports, and I like sports too, but like you're like, hey, what are you doing Sunday afternoon? Oh, I can't do any of that, I'm watching the game. I get, that's awesome. They have that same energy towards these things, but then when it comes to money or businesses, they lack on that, versus the one thing they could do to make more is to actually invest in themselves, of understanding and studying the rules of investing or money, and understanding the emotional side of money, emotional intelligence of money, right? All of these things that are going to be playing in here are absolutely critical to you. I just want to share that with you guys. Hopefully that help you guys. All right, identify true north. This is a big one. So what I mean by this is, you know, I have had coaching clients before where they literally are killing it in the real estate side, and they get to a certain point and they're making really good money, $500,000 a year, and they're like, you know, I'm going to go buy a restaurant, or I'm going to go buy a lingerie company, or I'm going to go buy a maple sugaring factory. I'm like, well, this is a particular, they go, I'm going to buy a restaurant. I'm like, well, who's going to run the restaurant? And they go, well, I am. And I said, well, then who's going to run your team? Well, I can do both. I'm like, have you ever tried to run a restaurant? No, I haven't. So they forget what their true north is. This is mastering the boredom. This is understanding what your true north is and mastering it. If you look at the most successful companies in the world, they focused on one true north aspect of their business. Microsoft, Apple, Nike. I mean, Nike's not selling TVs, are they? Just do it, TV, right? No, they're not. They're selling a certain brand and image of what they say true north to. The companies that tried to identify and diversify, which is what Apple did before Steve Jobs came back, right? What Apple did, 200 products down the one, right? They were doing these things. They almost lost everything because there's no singular focus. There's no true north. So understand what your true north is. Now, look, I'm not saying you can't go out there and own multiple businesses. What I'm saying is you never want to be the one who gets distracted from the business. So if you want to go open up another business, you better have the right person running it from the beginning. So you do not have a job in that aspect of it. That's actually really crucial for you guys. It's understanding your true north and the value you can provide to that stuff. All right, so let's just jump into some basics of what it looks like in terms of starting out with how do I start fundamentally understanding money. Now, first of all, stop using your business account as your personal account and vice versa. Typically, when you see P&Ls, they're not a P&L, they're a profit and loss of my life. Right? And some of you guys are laughing like that. I did the same thing when I first started out. I had a P&L, and I'm like, man, I made all this money, but then at the end of the day, I didn't really make any money because it was all of every single thing that I spent money on was going into my P&L. It wasn't really a P&L. It was a P&L of my life. And it's fine. You should classify and keep track of your personal expenses, but on a separate P&L. And that way you understand it. So first thing is you should create a separate account. You can create a separate LLC. Sub S is probably going to be your best option, but check with your local state and regulations and your accountants. Spend the money to get professional advice. I'm going to give you some guidance right here, but spend the money in your area. So again, create a separate LLC. Have your commissions paid to that LLC. Pay yourself a salary from that LLC, and that salary is what you should live off. All right, let's back up. Create an LLC. The money from your commissions should be paid out to that LLC. If you can do that in your state, most states you can, some states you can't. But pay it to that, dump it into that account, and then out of that account you pay yourself a salary. So if you say, look, I can live off $100,000 a year, and the rest of it is going to go back into growth. That's how you hold yourself accountable to the dollars. That's how you hold yourself accountable to where it is that you need to understand so you can pour everything back in. Otherwise, when money flows in and you sit there and you look and go, oh, I got $50,000 in my account this month, you go and buy shit, right? You get yourself in trouble. This is literally where you're like, hey, how many things can I go out and get this year? I'm going to go this. I'm going to go on this trip, right? You get, especially in good months, you see these things, and all of a sudden you get lost and get yourself in trouble. Whereas if you pay yourself a salary and it comes in your personal account of your salary, you know exactly what it is that you can do. Now, I'm not saying you can't live or take a distribution here and there, but set some goals up for what it is, and then maybe it's I take $500 a month and put it aside to my fund, fund my fun experiences that you have, or $1,000, whatever, how much money you're making, you can kind of figure that out. So create the LLC, and then pay yourself a salary. Start with these best practices, and if you can stay true to this, your organization will grow faster with it. I'll give you an example for Gary. He literally was making about $1 million a year from his market centers. Remember, they had no cap at the time, so the market centers were paying all that out there. And he paid himself $150,000 in salary, and that's what he lived off. That's where he took it. He's like, I still took a bunch of vacations. We just went camping. We drove to these things. We made it happen. We focused on the experience instead of how much money we could spend on vacation. Now, I'm not saying at some point you're not going to increase your sunsets in Italy, Adam, but what I'm saying is you need in the beginning to be as frugal as possible so you can actually have it is for having that jet in Italy, right? Those are the things you need to think about. So pay yourself a salary, live off that for a period of time until you get past that growth phase, and so you have ample cash in there, so you pay off your house, right? These type of things, and then you can start really increasing your lifestyle. By the way, this will blow you away. Gary did not change his lifestyle personally until he was making in the mid $20 million range of net income. How many people would not? I wouldn't. He's got me there, right? But you get the point. See, that's how frugal he was. It wasn't frugal. It was just, he just put more. It was just a tool for him. It's a tool. Money is a tool for him. It's something he taught me so well that it's just a tool. It's not going to provide you happiness. It's not going to provide you the feeling you're looking for. What it is a tool to allow you to have options in your life for certain things and to grow a business and to provide more opportunities. Because I guarantee you, if you put it into growth and you keep hiring best people around you, you're going to get a better feeling from watching your team succeed than you ever will from a dollar that's going to come your way. But it's so great to love money too. So I'm not saying that we don't love money. I'm just saying put it back into growth and then allow that growth to hit such a high level that it keeps flowing. All right. So one of the things that when we come up to a shift or any downturn or any rough patch, look, the economy, if you're doing well, your area could get hit with a natural disaster, or your area could just be affected, or you personally just might be having a tough go right now. Right? You need to understand that to keep the cash flowing, you have to invest in the people. This slider here came from a long conversation that I had with Gary about, okay, how do you invest into the right people when you're predicting a shift and everyone trying to cut back on expenses? And one of the things he told me, he said that, the reality is, Adam, is when a shift occurs or a market changes or economies change or influences from economic factors influence how business is done, the right person may save you from all of that. So go hire them. There's a different way of thinking, right? Instead of going, well, I can't, people instantly go, well, I can't hire these people. I got to have this shift. I got to do these things. The fact is, you actually can't afford not to hire those people if they're the right people. You got to figure out a way to do it. So number one, right, hiring the right person is never a risk. Now, I want you to underline a couple things there, even on your computer screens right there, right? The right people. The right people. This is why when they're not the right people, you get out of business with people fast. This is also why you do and have a lengthy screening process, i.e. the career visioning process, to have a higher probability of bringing the right people into your organization. So hiring the right people is never a risk, because not only should they give you time, but they should be giving you a return on their money. Everyone needs to pay for themselves in your organization. And by the way, it shouldn't just be one-sided. You shouldn't be going, oh, I got time back. It should always be a twofer. You should always get your time, or somebody in your business should get their time, plus you should see a return 3 to 4 times of their salary or the amount of money they're making. That's a reality of how you kind of baseline that, of hiring the right people is never a risk. Number 2, hiring the right people is the best investment you can make ever, period. Best investment you will make. And that comes because if it's the right, the key is the right people will give you the largest gain of your asset ever. Think about Tom Brady. Was he a good hire? Yeah, he was. By the way, the only reason why he's playing is because Drew Bledsoe got hurt and he was second bench. Brought in the right person. Now look how wealthy the Patriots organization is from a business standpoint because of a couple people. I'm not saying it's all Tom. I'm saying that the right person has a catalyst to do this. Just like one person in your organization won't. But if you have a collection of these right people, man, watch out. You're unstoppable. You can feel the momentum pushing and creeping like, hey, it's almost like an excavator is pushing dirt. It's like, get out of my way, I got this, right? And then when problems come up, you have such a great people and such a team and a force, they just snap the problems in half. Not even problems anymore. Just gobble them up. Whereas if you don't have the right people and you're trying to pull people like you got 10 people on your team and they're all rocks behind you and trying to pull it, and all of a sudden a problem happens and you're like, man, I have no energy to deal with this problem because I'm just trying to deal with my people. That's when he's got wrong people. It should be the other way around. You should have so much force and energy going forward from hiring the right people that when problems show up, you have the energy to attack it. In fact, you wake up every day going, bring them on, because our team can handle them. Because that's what you're going to need in order to build a large business, right? Taking territory. Number 3, hiring the right person is a powerful offensive move. So again, even in times of shrink or if there's a shift or anything like that, hiring the right people can be when everybody else is retreating, you advance, right? By the way, this time of year, people are always like, hey, I'm going on a retreat. I'm like, what? You're going on a retreat? You're going on an advance. You want to advance your company forward. Just think about the language you use. You don't retreat anywhere. You advance, right? Hiring the right people is a powerful offensive move you can make to gain territory, to gain traction. Maybe it's bringing on that mega agent to join your team, right? Maybe it's hiring that director of ops that you need, or hiring a new CEO, or hiring a transaction coordination as your second hire, or hiring your first admin person so you can go out there and be as powerful offensive, not worry about anything else you need. It is a really, really awesome move to make. Okay. So here's what I want you to do. Remember, you can make all the money in the world, but if you don't manage your expenses, you got nothing left. So really, profitability comes from your expense management is how profit comes from. You can be a $14 billion company, but if you're spending $14.1 billion, you're still losing $100 million, right? So that's not a good thing. So what I love all of you guys to do is over the next 9 months, and by the way, I want you to get around the fact that there's no seasonality, but just in fact that most of us understand that there is a seasonality that's there, and you can power through that if you're willing to increase your activities. But understand, if there is a shift or if there isn't, what I still want you guys to do is over the next 9 months, make this a game and cut expenses every single month. Now, I don't think you should cut people unless they're the wrong people. In fact, you may need to hire people during this time. What I want you to cut for expenses are the fat that's out there, and we all have them in our organizations. Hey, I bought this thing for $20, for this $19. I'm talking about the little things, like, hey, we spend $3 a month on this. Do we need it? And maybe it's just too lazy to even delete it. Go do these things. Go cut off your credit card, by the way, and see how many companies call you if you don't know all the things you're getting, right? But what I want you guys to do is over the next 9 months, play it a game, make it a game of how much money, how much expenses you can cut every single month. Make it a game. Can you cut $1,000 the first month? Then can you cut $500? Right? Can you cut $100 a month? Look, these things, what this does and what the practice of this does is to get you to identify expense management and then using the profits to fund growth. And when you come at business building from this angle, from understanding what money really is from these angles, then you're a individual that's equipped to handle the grind and the challenges that come from business building. So I want you to aggressively cut the expenses for the next 9 months. Make this a game. Reward your people for this, by the way. If you're the one doing it, reward yourself. Maybe for every dollar you save, you take 10% of it and you put into a fund for, to buy something for yourself or for somebody, or donate it, right? Whatever it is, but make that part of make it fun. If it's for your team and you have a CFO or somebody else who's managing expenses, make it have them. Make it about them. Say, hey, I'm going to give you 10% of everything that you cut 1 month. Right? They go cut 10,000. It's amazing. All of a sudden, oh, there's nothing to cut. I'll give you 10% of everything cut. They find 10 grand to cut. It's funny how that works when you incentivize people with actual money. And so think about those types of things you can do to make it a game, make it really aggressive for people so you get the true benefits of all those things happening. So the other way about money is how to leverage other people's money. The thing I want to talk about here is understanding that there's more cash sitting on the sidelines than there has been in really the last 100 years. Specifically 100 years, because we're a larger economy now, but literally there's been a lot more money. Ever since the crash, people have taken money, and literally there's a lot of cash sitting on the sidelines. So if you have the right deal, if you have the right investment, there's plenty of money on the sidelines. So don't, in your mindset, really what I want you to take away from this is money should never be an obstacle to hold you back from something. And you instantly go, well, that sounds really good. It sounds awesome, and I get that, but I have these real things. I don't have any money coming in there. Well, figure out a way. Do you need to go hire or partner up with an investment firm to go take in $500,000 for 30% of your company to go build it? It's up to you to decide, but money should never be a hindrance of your growth. And which is why you have to understand, which is why Gary franchised. It was a form of money raising. Right? He went out there and he didn't pay to set up these things. People paid him. So there wasn't any additional cost. Remember, franchising is just a way of raising money. Amazon, Google, Netflix, Facebook, every single one of the companies you've ever heard of, by the way, has raised money. because they realize that if they want to grow faster, now I'm going to take 80% of my company, but I'm going to get $1 million for it. And I can accelerate my growth for the hiring of the systems and the people, and to have a cash flow line or invest into this that I can have that's going to propel my business forward. So if money is your issue from allowing you to grow, maybe it's not because you don't want to grow that fast. But if you're sitting there going, man, if I just had 100 grand, I'd dump it into this and this and this, then you may go, all right, well, how do I go out and get that 100 grand? What is it a loan from somebody that I just pay back? Is it, do I sell a percentage of my company? I want you to be creative in these things. Just because you're in real estate doesn't mean you can't do these, right? This is use other people's money. We're huge on this, especially on the investment side, right? Specifically on the real estate. The really cool thing about real estate investment is we have a parent company, BlackRock, and then we've got a bunch of subsidiaries. And a lot of our subsidiaries, we raise capital based on the project. And since we're in the beginning, we were giving up a ton because we didn't have a track record. Now we have a track record and people are reinvesting back into us. The game changed. We may go into it and we may lock the deal up, get it to a certain place, and we may sell all the money we need to raise. If it's $1 million, we may raise $1 million and give them 25% of the company. We keep 75%. People go, well, that's not fair. So what do you mean? I don't need your money to do it, but if you want to invest in this, I can. And so then you're in the driver's seat because you have the deal and you've got it to a certain level. So getting the deal a lot of times, and then if you go to sell that asset, you're not selling the company, you're just selling part of the asset. You're selling a separate thing. You're not like, when Facebook sells, they're selling all the people and the systems in there. When you get a separate piece of real estate, you sell it, you're not actually selling your parent company. That's the really cool thing about construction and development, mostly for assets, and retained assets. All right, it's my spiel on other people's money. All right, so managing cash flow, net income versus cash, understanding. How many people have literally, they just paid their taxes are coming up, sorry to bring that up, but they look at their tax returns, they're like, man, how did I make all this money? Where's my cash? I am not the only one that does that every single year and goes, man, I made all this money, where is my cash? Where is it all? Right? I know other people have the same problem. And so the reason why is because what really matters, your net income doesn't really matter, your free cash flow reports matter every day. That's what free cash flow matters more than anything else does. Where is your cash being sourced? And that's a really important. If you make 50 grand at the end of the month, what's the usage of that cash? 30% to taxes, 10% personally, 15% for this growth, or this, extraordinary expense here, or this thing personally I had to go. And all of a sudden you track it, and you're like, man, all right, I got to get a hold of this. But in order to get a hold of it, you have to understand what your income is, and you have to understand what your free cash flow is. And by the way, most bookkeepers, 99% of bookkeepers, will probably be like $100 to $150 a month to do your books for you, and they can give you a free cash flow report for your business. The same thing when you get a balance sheet and you get an income statement. But really, net income statements and balance sheets are just a snapshot of a certain point in time, whereas free cash flow is up to date of exactly how your sources of money are being used. So just understand the difference, and really what you need to do for P&Ls and these type of things is literally go out and hire a bookkeeper to handle this type of stuff. All right, so keeping the cash flow rolling. Ensure that each system has a number assigned to it needs to be hit. How you hold your money accountable, right? Regular reporting on ROI, regular audits, create a system of checks and balances. Part of your, ensuring that each system has a number assigned to it. Like if you went out and bought a lawnmower and you brought it home and the lawnmower didn't work, would you return it? Yeah, you would. Well, sometimes we hire people and they don't work out and we keep them. And you just keep putting money into it knowing it's not going to work out. Well, you're hurting that person, you're hurting your organization as well too. And the same thing with a system. You go out and buy a system and you don't use it, and you're like, maybe I'll use it someday. It's like the whole, your closet. You have all these clothes in it that majority of the time you never wear again. By the way, a great trick for this on the closet is you want to declutter your closet. You should ask yourself the question of, would I buy this again for retail value? And the answer is no, throw it out. Clear that clutter. It's the same thing in the system. Would I buy this system again for $29? The answer is no, stop it. You won't use it. It doesn't even matter anyways. There's like 2 sources or 3 sources of where leads come from. Your sphere, one platform that you have, ours is Boomtown, and maybe one other source that you have. The 3 of those are going to be the major sources of where all your 3 to 4 is going to be the major source, and the majority of that's going to be 1. Just need to focus more on that. Regular audits, again, your bookkeeper can do these things and figure out some sort of checks and balance systems. If you have a larger organization where money's flowing in and out and you're not personally managing your money anymore, which in itself is its own weird feeling to give up, especially if you're a control freak like I am, and all of a sudden you give up all your money and you've got all this money going in and out all the time, you can't even keep up with it. You got to have checks and balances for that, and so that's a really important system to do. And your people can do that for you, you know, or you can have separate bank accounts, different authorized signers. There's different ways to check on that. So here's a sample P&L of one of our teams. This was 6 months through the year, right? You can what I want to show you here is we broke this down to buyer incomes, listing incomes, referral incomes, so you can actually track separately buyer incomes and listing incomes and the expenses associated with each. But really that's how you should break it down into, and then you pay out your commissions, so you're seeing your cost of sales and rental commissions. You can also set up the agents' names have been changed in this, but you can also set up the agents in here, so you can see exactly in your P&L how much you've actually paid gross to those agents to see top-down reports of what it is they're being paid, and it's also allocating your cost of sales. So when you do percentages of things, it's a much better percentage of what it is, right? I think this one we were right around. I forget what it was. I don't know actually where the P&L is from, but you can see the examples of all these things. You know, company dollar, royalties, all of the things that are costed in here, cost of goods sold, expenses, how everything's allocated on this stuff, whether the salaries are for you or for management, and other different stuff in there. So break it down, right? Break it down to a point. I'm just going to try to. There's a program of P&L that includes agents. Yeah, so you can do this on QuickBooks. By the way, your accountant can set all this up for you, Helen, so you understand that. And they literally can set it up. You just put all your agents in there, and then every time any cash that gets paid out of that, you take the green sheet and they input that information. So it's just a lump sum, so that you're pulling in all the correct data and not just what the net check is to the company. So you have a bunch of buyer agents and say they're on a 50-50 split, $10,000 commission, you want to record the $10,000 commission, and then you want to record the $5,000 payout to that buyer, right, to the buyer's agent, and include that name. So you're actually tracking these things from an accurate standpoint. And it's just a system. Once it's set up, it's super easy. Again, it'd be like $100, $150 at most to have a bookkeeper come in and do this monthly. Or you can come in and just do it weekly as well too. But QuickBooks is great. They have QuickBooks Online. They can do this stuff for you pretty easily now. But that's the kind of process you want to do and be as detailed as possible. You can collapse these, by the way, so you don't have to. I just had the example of showing you all the different items here. You don't necessarily have to have them all out that way. So let's kind of briefly over this. This is kind of my traditional 4 investment opportunities: your traditional investments, real estate, business, and then business ventures. And dive into a little bit more in here. We've created, with Gary's help, a kind of a 9-point investment philosophy for me for what we do. And I just want to quickly talk about a couple of these for money. Invest based on risk profile, determine internal joint venture or syndication of investments, meaning is this something I'm going to do internally with my own cash, or I'm going to source it for cash outside. Invest in projects of scalable size and use where we can only add value. The same thing is I will only invest into a business that's scalable. Something that's small doesn't excite me. It's got to be scalable. Expansion, right? Anything else that you're doing that can be scalable is where you want to invest, because otherwise it's not going to get to the level you want to go if you want to build it big. Invest where your money is where your money going, and always has a margin of safety. So really the goal here is, if we're looking at an investment deal and I look at it and say, okay, we're going to make $1 million in this deal, if I can't cut that profit in half and be okay with making $500,000 in this example, then I won't do it. For instance, if we said, oh, we're going to make 50 grand in this deal, if I cut it in half and it's 25, then we're just not going to do the deal. Here's what I found: whenever you do initial numbers on paper, they always look a lot better than they are when they actually happen. Majority of the time, you get the outlier here and there, and that feels amazing. But the majority of the time, they're always cut. So I always cut it down to see if it's still accessible. Invest in what you know and understand. It must fall in your area of expertise. You must be easily able to explain it. Most people can't even explain what they invest into, or sometimes people can't even explain what you need to invest into. Invest in something that's unique, can be getting elsewhere. 6, invest in the moats. This is really interesting, actually. It says moats is a barrier to entry. I don't know if you realize, you know that moats were actually created to keep people from leaving? I don't know if you knew that, but moats were originally created because every time people would set the like the castle, or wherever the moat is on, or the land, or the providence, whatever they called it, when they would set a tax to be levied, people would leave. So what they did is they created this moat, so then people couldn't leave when they instituted a tax within their organization, and they rolled up the gate, so everyone had to stay in there and pay their tax. And so I use it as an example of somewhat joking, but also invest in the moats. Like, do you have moats for your people, right? Are your people in moats? Do you have a system set up so your people never want to leave, right? What about your organization? Same thing. Are you investing in the moats for your business? What's the barrier, right? Invest in the people first, ideas second. Always pass on a good idea to avoid investing in the bad people. People first. People first. Who first, then what? Who, then what, right? Invest internal cash on deals, most upside, minimal on the downside. Invest 50% of our core functions. That just means that it's just something for us. Doesn't make sense for you guys. All right. Money mindset. Money is only good for the money it can do. Understand that money is really only good for the money that it can do. And why is that? Because understanding what money really is. It's a tool. It's an asset that's in our lives that we can do this. And now, a lot of you on this call are intellectually understanding that. But until you can really start following the best practices of money, understanding money, and seeing it as a tool in your life, you're not going to fully comprehend it. Now, being obsessed about making other people's money, being in love with making a lot of money so you can help other people, I think, again, it's very selfish if you don't want to make a tremendous amount of money, because you never know when people around you are going to need it. It doesn't mean to go, have 17 homes. In fact, having all of that stuff just makes it more stressful for you in your life. You understand that, right? The more stuff you have, the more stressful it is. Even if you have all the money in the world, it's still very stressful, which is why you're seeing the secular change occur of people not buying things anymore. They're buying experiences. Because I realize the one thing money can buy is the experience they're looking for. And that's the gift of having this, and the gift of being able to make a lot of people around you a lot of money is the fact that they can gain the experiences that they're looking for. That you, with your business, with your organization, with your world that you're creating, can give people the opportunity to experience what they set out to do in life, whatever that is, to be able to do these things. That's why money is good for the good that money can do. And you hear this phrase, and it's very rudimentary, and you can understand this, but this is really where it's at. That it's a tool, it's emotional intelligence of how well you can use this. That's how you increase balance sheets. That's how you increase your wealth on these things, and you've got to defer your gratification. Choose growth before profits for a period of time, so then when you take out your profits and you start taking money off the table, it's not affecting your growth. Therefore, meaning you're making enough money that you can still invest the proper amount you need in growth, but now you're taking a bunch on the profit side because you've already allocated 10% for growth. And in the beginning, that was your profit margin. But now it's 30% or 40%, and you're making all this traditional amount of money, and you can pour 10% back in, and now you can take off the table 20 to 30%. And that's how you start allocating those certain levels of things that you can do for that. So I want you guys to take away from today, right, is understanding your P&L. If you don't have one, or if you're using it as your personal bank account, which a lot of us do, then what I need you to start doing is separating the two. And I don't care if you put like $100 in your personal account and the rest of it in your business account, it'll keep you in check for that, right? Then maybe what you do is stop using a credit card or a card and just take out cash and use the cash for things that you can do. By the way, there's a much emotional response using cash than there's a credit card. And so when you have cash around, it makes you think twice a little bit more about what you're buying for it. So separate your P&Ls. Get very clear on what that is. Understand how much money you would like to be paid as a salary, and it's after tax, right? So if you want to make $150,000 after tax, how much salary you have to pay you? If you want to, if right now you can make only $50,000, is that an acceptable number for you? If it's not, look at your lifestyle. What is it you can do? If it's $200,000, great. Look at your lifestyle. What is that? Okay, I want to maintain that lifestyle. Then you need to go on the offense, right? You need to go really big on the offense to really get yourself past the hump. By the way, it's really only the first couple years that you point everything you've got back in. And I'm not saying you can't increase your salary each year, right? It's just because you can start taking some money off the table, and that comes. But in the beginning, stay as focused as you can, especially if you decide, I'm going to hit a big growth phase, and this is me, boom, I'm going to do this. Keep as much as you possibly can back into your business, and use the government as your partner as you embark on this. All right, so I do have a little homework for you. What I want you guys to do is create your P&Ls, review your current P&L, and find out where you can cut expenses. Remember the game. Make it fun. Make it about you. Figure out a reward system for it. 9 months in a row, I want you to cut expenses. Not in people, unless it's the wrong people, but cut expenses. Figure out a way to do it. Make it a game. Incentivize yourself, if it's individual you, or just incentivize yourself anyways. Figure out a percentage you want to save, that you'll take and make it part of your fun experiences that you do, Or make it about other people. If they cut expenses, do they get a bonus from this? Or does your whole team get a bonus? Or does your team get whatever it is that you want to do? Do you want to profit share the amount you want to save over the next 9 months? So every month you collect it and put it in a separate account, right? Just make this fun with your team, right? It's the things you can do. So I want you guys at homework. All right. Thank you guys so much for allowing me to serve you guys today. You are awesome. Have an amazing day, and we'll talk next week. Later.